The Dunedin Income Growth Investment Trust invests primarily in UK companies with selective overseas exposure. The aim is for long-term income and capital growth. But how is management coping with the current investment, economic and political environment amidst recent volatility caused by questions around AI? Ben Ritchie is the co-manager of the fund and joins us now. Welcome.
Thanks very much, Jeremy.
We mustn't lose sight of the fact that this fund goes back over 150 years. That is quite a track record. I won't ask you to go through the whole history, but is there anything we ought to know about its history and its composition and where we stand today?
Well, it's a really interesting question because Dunedin is the oldest Scottish investment trust. It's the second oldest investment trust in the world. So it's got a lot of heritage. It goes back to 1873. It was founded in Dundee by Robert Fleming, who was effectively the father of the investment trust industry, went on to found Fleming's, which I guess is now part of JP Morgan. Back then, it was targeted to invest, I think, a high and growing income stream from investing in the emerging market that was North America, and primarily in railroad bonds, which was I guess, the hot thing at that time, maybe the AI of 1873. But today, interestingly enough, while the asset class has changed from bonds to equities, and while we no longer focus investing in North America, I think that fundamental goal of delivering an attractive total return with a significant portion of income making up part of that hasn't really changed. And while the trust has been through a number of iterations over the long term, I think what we're trying to do today isn't wildly different from what was expected over 150 years ago.
As of this moment, there is some political turmoil here in the UK. Keir Starmer leading up the government, which has been around since, of course, July, a year or so ago. Talks a little bit about how you're structuring the fund, bearing in mind the political, geopolitical risks as well, globally, as well as here at home, and the economic backdrop. What's your thesis?
Well, I think that the thesis, Jeremy, is very much rooted at the company level. So when we're investing in businesses, we're targeting high quality companies, which we think can weather, to some extent, any environment. Because whatever we say, we don't know what's going to happen, from a geopolitical perspective, from a domestic political perspective, from an economic perspective. The future, as they say, is unknown. But we want businesses which are in a position to be able to manage through almost anything that's thrown at them. And that's about having really strong business models, good long-term structural rather than cyclical growth prospects, really strong balance sheets, great cash flow, really great management teams, and good overlying sustainability focus and also governance. And those are the building blocks. So that's really when we're looking for businesses for the portfolio, we think if we get all of that right, then businesses should be able to navigate through whatever is thrown at them, whether it's a political change, an economic change, or even a technology change, such as AI. And then we want to put that into a portfolio that's diversified. So we have different companies at different points of different cycles with different geographies and different business models that give us a range of different dynamics within the portfolio. And that's something that's really important to us. So it's starting with sustainable long-term growth and with a focus on the downside.
So do you feel comfortable with valuations at the moment? Would you be interested in buying into this market, or do you think there's a little bit of air still has to be taken out of the tyres before it becomes attractive?
Well, UK equities have been a very strongly performing segment over the last 5 years. And I think there's a strong correlation between people talking about something being uninvestable and then looking back in 5 years' time and finding that it's delivered you a very good return. It's an interesting dynamic today when we look at Dunedin overall. The valuation premium that the companies within Dunedin is trading at relative to the market has collapsed. So the premium that you're paying for high quality companies has really come in a long way. So you're paying 4 or 5% premium versus perhaps a 25 or 30% premium for companies that are generating significantly higher returns on equity, significantly better margins, significantly better track record of dividend growth with much better balance sheets. So we think that quality growth part of the market that's really lagged a number of the very strong cyclical performances which we've seen over the last 4 or 5 years is extremely attractively valued, and that's exactly what Dunedin is centered around.
Yeah, talk to us a bit about the themes you're following at the moment, because you mentioned technology, but there's lots of themes to follow when you're looking at this sort of trust, which is fairly widely spread.
Yeah, I mean, it's very much thinking about things that are going to be long-term earnings growth drivers for businesses. What are the things that are going to be in place, regardless of politics or geopolitics? And when we're thinking about those sorts of things, we're thinking about technological change. We want companies that are on the right side of the evolution of technology as we see it coming through. And there's clearly quite a lot of debate going on about that, with the sort of steps forward being made in AI and what that means for different companies, and we can talk about that. Also very interested in demographic changes globally and what opportunities that opens up, both in wealth provision but also in healthcare. And then also, I think, sort of changing consumer trends as well. Again, being able to link into companies that have got strong and enduring consumer brands, such as Haleon in the consumer health space. Those are dynamics that have been around for a long time, which will continue to be around for a long time, and which we can sort of anchor into at a time of a lot of geopolitical and macroeconomic uncertainties.
Let's pick up on the growth income part of the business. My understanding is that you've got a fairly long-term income growth, or at least at very minimum, the income is being kept at constant levels year on year. My understanding is, I think it's 45 years you've had under your belt. How do you do that, and what are the prospects from here?
Yeah, so within Dunedin's framework, I think it's 45 years where we've either grown or maintained the dividend. So I think, unfortunately, back in the early 2010s, we didn't increase the dividend just after the financial crisis. If we'd known about dividend hero status, we probably would have put it up like 0.1% at the time, but we didn't do that. But the trust has had a very long track record of maintaining or increasing its distributions back over that 45-year period. In terms of how we think about the trust, the board made, I think, an important change in the summer last year, where we effectively delinked income generation from income distribution. So we said, given changes in the market environment, it no longer makes sense to us to only pay dividends out of income generated, because what we've seen over time is that the yield on the FTSE has remained around sort of in the low threes, but increasingly companies are looking to use buybacks to distribute back excess capital to investors rather than dividends. And that now makes up more than 200 basis points, or 2% above that dividend yield. And so we want to be able to take into account both capital and income generation in terms of our distribution. And the other element which we've seen is that cash rates today are much higher than they have been. And we want to be able to reflect that in the yield which we're distributing out to shareholders to make Dunedin an attractive prospect. And so we increased the dividend by just over 30%. We will have increased it just over 30% to give a yield on NAV of 6%, which with the current discount is perhaps around 6.5%. So we think that's a competitive yield versus cash and the market, which is on about 3.5%, and the wider sector, which is a little bit of a premium to that. And then we also think that delinking of our distribution from how we're generating capital gives us, I think, a lot more flexibility as well from an investment perspective. When we think about the overall portfolio, though, we do think about having sort of 60 to 70% of the portfolio in companies that are capable of perhaps generating consistent long-term growth, but at a lower level of yield, and then having between 20 and 40% invested in higher yielding companies, slightly lower quality businesses, but offering that higher level of income. What the change to the policy has done is give us just a little bit more flexibility about how we allocate between those two areas.
You mentioned dividend hero status. Is this become a really big thing? I mean, it's I guess a nice label to have. I think it means you've grown the dividend as opposed to keep it stationary, haven't you? I think the whole point is you grow it over, was it 20 years or so?
I think it's 20 years for dividend hero status, yeah.
So is that important these days? It is a label that you can sell the fund to?
Well, I think it's one of the great attractions of investment trusts is the ability to utilize reserves to be able to smooth out dividend payments. So, in the open-ended space, you're much more tied into the amount of income that you're generating in any one year in terms of what you can distribute, rather than the ability to build up revenue reserves over time. And Dunedin continues to have around 60% of 1 year's dividend in revenue reserves, which is a sort of a first port of call to help support the dividend distribution. But we also have, on top of that, about 13 years worth of dividend in terms of capital reserves, because Dunedin's been around for a long time, so it's built up a lot of realised capital gains over time. So we also have that. But really importantly, Jeremy, we also have the gains which we generate on an annual basis as well. And it's that combination of our ongoing capital gains and the income which we generate, which ultimately funds the dividend. If we need to, then we can dip into both revenue reserves and, if required, capital reserves. But it's that flexibility of the investment trust structure that I think really people find appealing, because it really underpins those distributions.
Let's talk about quality. I believe it's been sort of under or out of favour against the more value-driven UK equity income strategies. How do you assess quality at the moment?
Yeah, so it certainly has been, and if we take that as a proxy, just to give you some idea over the last 12 months, if you look at the sort of quality index as part of the UK market, and also if you adjust it for sustainability, so some of the sectors where we're not able to currently invest, like tobacco or defence, it's up maybe around 1%. The wider market's up over 20%. So the kind of companies that have been in that space have been somewhat unloved. They haven't been delivering catastrophic returns, but they haven't been, I guess, where the really exciting upside has been. And the UK market returns over the last 12 months have been particularly narrow. So the vast majority has come from banks, tobacco, and aerospace and defence. For us, banks, it can be difficult from a quality perspective. We do own some banks within the portfolio, but we're generally quite cautious about that as a long-term investment. Tobacco is excluded, as is currently aerospace and defence. So again, that has not necessarily allowed us to participate in some of the most exciting parts of the market over the last year, or indeed over the last several years. But I think underlying all of that, the companies within the portfolio have continued to do pretty well. And when we look at the returns that we generated during the year, we've had 5 or 6 things that have done phenomenally well. So something like ASML has more than doubled over the course of the year. Prudential has done something similar. M&G has had a spectacular re-rating. Chesnara has really been rewarded for doing the deal to buy HSBC Life. Genus has finally started to see investors come back to these stories. They've got permission for their new gene-edited pig products. Some companies in the mid-cap space have also started to see some signs of life. So there's been a lot of good stories to get enthused about. We just haven't had as much excitement as the wider market.
What about the sustainable areas of investing and responsible investing that people call it? Is that something that is live at the moment, or has that taken a bit of a backseat?
I mean, it's definitely drastically out of favour. And investors, at the end of the day, do tend to be led to where the returns are. So, and I think that is just a fact of life. So, aerospace and defence, mining, tobacco, all areas which have done very well, and all areas which for various reasons are difficult for us to get access to with the structure of the trust. And that doesn't mean that we don't recognise that there are opportunities in some of those segments, but as we're currently structured, that is difficult to access. I think that said, over the long term, we think thinking about sustainability is important. I think the longer your investment time horizon, then elements around political interference, regulation, environmental taxes, changes in regulation also all become more important. And so making sure that we're on the right side of that over the long time, we think is really important. And we've had companies that have benefited within the portfolio from some of those trends, despite perhaps it's not so much an unhelpful background for sustainability-orientated companies, but it's just been there's been more tailwinds for non-sustainable companies, I would say, has been how it is. So something like National Grid has been a cracking investment, and we did an update, that must have been a couple of years ago, just after National Grid had its rights issue, and being asked about that, and you were able to buy into National Grid at the time with a dividend yield, I think, of over 6%. Which will grow at least in line, with inflation plus. So, you're really locking in a double-digit plus return. And I said at the time, I'd put the whole portfolio in the stock, because at that level, you're effectively getting almost a guaranteed type return. And that's actually been a really good performer for the portfolio over the last couple of years. So, and that's really being driven by, the increased capex requirements to effectively electrify the grid. And so, there are still attractive, sustainable tailwinds. I would just say that there have been more tailwinds in areas that have seemed to be less sustainable, and that's really been that element of missing out that the trust has had, rather than the underlying delivery within the portfolio has been absolutely fine. It just hasn't been as exciting as the wider market.
I think it's about 40 stocks, aren't there, in the portfolio? I believe that's
37
at the moment. 37 at the moment. Is there much churn? Do you get an opportunity to say, okay, we've done that, finished that, I want to exit that now, let's look for new opportunities?
Yeah, so we're always being pretty rigorous in terms of the implied return. So Rebecca and I were very, very focused on what is it that we're expecting from each and every holding. And every holding is ranked in terms of both the returns we're getting today, so free cash flow yield and earnings yield, and what we think the sustainable long-term growth is. And we're always looking for at least a double-digit type return. So as share prices rise, if our expectations on growth and earnings are not changing, then structurally we're looking to cycle out of some of those companies and allocate into businesses where we see better total return. And we're also always looking looking for companies that can bring something different to the portfolio. And I talked earlier about that portfolio construction mix. That's something that's extremely attractive. So if we can find businesses that have different end markets and different drivers, then that's something that's particularly appealing to us. And one of the stocks that we bought in the second half of the year was Tesco. Not a company that'll be sort of anything radically new to anybody, but a business that was trading on around 13, 14 times. So turn that the other way. You're generating a free cash flow yield of 6 to 7%. You've got an earnings yield of 6 to 7%, and a business that's capable of growing its top line perhaps 4 to 5%. A little bit of operating leverage, bringing into play some higher margin activities. You should relatively comfortably be able to generate a good double-digit return from that investment. A good portion of it coming through income, supported by buybacks, very strong balance sheet, relatively acyclical. That's the kind of investment which we sit there and say, okay, that's looking pretty good, and we should be able to make a good, healthy double-digit return. Now, the good double-digit return in most years will look pretty good. In a year where the market's done 24%, it's going to look less exciting. But that's the kind of thing which we're looking for, and it's looking to cycle out some of those businesses where we feel that the valuation is no longer there. Occasionally, we'll have companies where the quality has deteriorated. That tends to be rarer. I mean, one of the stocks that we sold in the second half of last year, or just in the summer, was Novo Nordisk, a stock we'd owned in the portfolio for nearly a decade. But after some of the changes to management, after their inability to navigate that fundamental shift from effectively being a pharmaceutical company to being more of a consumer company, and also a pharmaceutical company that was becoming increasingly reliant on new products, which brings a lot of risk in the pharmaceutical space, which was the reason why we had liked it in the first place, which it didn't really rely on that. We took the opportunity to sell out in the summer. That felt pretty tough, Jeremy, at the time. Because it had probably peaked at 1,000 Danish kroner in the summer, and we probably bought it at 150 or something. So it's done very well, but come back. But we sold out at sort of just under 400. That felt quite painful, but it's just over 300 today. So we were prepared to make a tough decision to exit a long-term holding, because fundamentally we felt the business model and the quality had changed. And while that was painful, it's proven to be the right decision and be able to reallocate some of that capital into other things.
Let's talk about technology and the new tech, AI, how that has changed your life as a portfolio manager over the last 3 or 4 years or so, and what you're doing, what your attitude is to that part of the market at the moment.
So it's extremely topical. We've seen a big sell-off in companies perceived to be, I guess, AI losers, where their business models are seen to be at risk, either that they're going to face increased competition or that they're going to be completely disintermediated as well. And that's particularly focused on software and on, I guess, companies that are selling data, and perhaps companies which are both doing both. I would say that this is not new. So we've been thinking about this for a number of years. And so when we put capital to work in this space, it's with companies which we believe have extremely robust positions, and where we think that there are actually opportunities to benefit from AI. As much as that there are risks to the business model. Now, the market is very much in the view today that it's looking at the risks and it's looking at the downside, and it certainly could be right. But on each of those companies which we own, whether it's Relex, whether it's Experian, we see companies that have very valuable proprietary data. It's not available for everybody to access, and where they've been investing for many, many years to be able to generate their own AI tools. And the evidence certainly that we've seen from Relex, and we'll find out later on this week because they're reporting results, is that they've been able to get their customers to spend more money with them because they're able to sell these tools. And effectively, what they're able to do is to move from selling data to substituting probably labor, where they're effectively saying access to customers who historically have bought their data and saying, yeah, but we can also supplement you with tools that can give you increased productivity. And so that's an upsell opportunity. It's also an opportunity to move into a completely new market. And so while there is uncertainty, and totally take that, as I say, this isn't new. We've been thinking about it pretty hard over the last couple of years, and we do think that these businesses are well positioned. I mean, Softcat would be another one. So effectively, it's a evaluated reseller. It resells software and hardware. It operates and works pretty agnostically for most of the big software and hardware sellers, and it's effectively servicing UK PLC. by their own admission, they would say UK PLC has been a pretty miserable place to be serving. They'd probably say their customers were 4 out of 10. But technology today is not a nice to have, right? It is a must, right? If you're not competitive, if you're not investing, then your competitors definitely are. And you need to be on the forefront of that. And so they've been able to grow very nicely. And so, yes, of course, it is possible that in the future, people may not need to spend money on some of the products which they're effectively reselling and helping companies to implement. But it's probably also likely that the picture is getting increasingly more complicated, that companies are going to need to spend more, and they're going to need trusted partners to help them navigate through this period. Certainly that's been our experience internally. We're certainly not looking to spend less, right? We're looking to spend more, and we're looking to use a wider range of vendors, which makes the space more complicated. Both those companies, Softcat and Relics, have seen their share prices significantly derated. We're confident about the longer term prospects for them, but we'll have to, ultimately the proof will be in the pudding.
Well, let's pick up on that idea and look from where we are now to where we're going to be at the end of the year and for thereon. How excited are you about the opportunities that are out there? Because I think it's the right way of looking at this in terms of where we are in terms of a relatively stagnant economy. I have heard people say they're more excited now than they have been for a couple of years about the potential prospects in some areas. Is that a fair assessment of how you're feeling?
Yeah, I think it's, when we think about quality within the market, it has probably never been at a lower premium. So I think fundamentally, quality is on sale. And that is interesting to us. As I was talking about earlier, the P premium for high quality businesses has never probably been lower, certainly in my career. The characteristics of those businesses hasn't changed, and the premium that they're able to offer in terms of returns and margins and balance sheets remains very, very, very consistent. We see sort of two areas, Jeremy, that we think are particularly interesting. So the first would be those more domestic plays that have been heavily out of favour. And we see a very interesting asymmetric setup where there's not a lot of downside. Companies with very strong balance sheets, strong businesses, but waiting for some kind of tailwinds to help them out. So it might be Taylor Wimpey in the house building space. The end markets are pretty subdued, but you're sitting on £350 million of cash, which is going to basically provide you and put you in a pretty good place. You're back at a multiple that you probably haven't been at since the GFC, when all these companies had a lot of debt. Here you've got a strong balance sheet, and you're really waiting for things to pick up. But ultimately, with a government that its stated aim is to encourage and build out of housing. So, hopefully we get some economic tailwinds, some policy support. But if we don't, you're still getting a pretty generous dividend yield and the businesses are well underpinned. Could be the same with something like Genuit, which effectively makes, it's more sophisticated than this, but makes plastic piping that goes in to commercial, industrial, domestic usage. It needs help from a stronger construction and infrastructure investment market. It's got good long-term structural growth potential. There are substitutes and regulatory benefits coming through to it, but it needs a bit of help. But it was interesting, and it kind of goes back to these market dynamics. I mean, they had an update in the autumn time, I think maybe just before the budget. Obviously, a lot of demand had been sucked out of the market by waiting to see what was going to happen. And that's what they said to the market. Things have been a little bit subdued. Over the next couple of days, stock price was down about 30%. Stock's already trading on 11, 12 times with effectively a very strong balance sheet. They're not telling you anything that somebody with very limited understanding of markets would already have understood. And it's always been my expectation that that should already be priced in. And what you've seen over the next 3 or 4 months is the stock price go back exactly where it is, with nothing having happened in between. And I think that's just really important that we should sort of bear in mind a little bit when we're thinking about some of the, the AI narratives that are going on at the moment, which is that at the end of the day, it will come back down to fundamentals, which is earnings, cash flow, dividend delivery from the companies. If the businesses, and we think they will do, deliver, ultimately they will see their stock re-rated. Now, if we're wrong and they don't, then they'll get punished. But ultimately that's the piece. And I think we've seen markets become, pretty reactive. I think we've seen the biggest moves on a one-day basis around results from companies, ever during the recent reporting season. I think that's a reflection of the fact that there's more money in index funds, there's more money chasing momentum, and there's more being driven by sort of hedge fund pods around these results. But I think over the medium term, that's an opportunity. If you believe in these businesses, these shares are coming to you on sale, and that should be an opportunity. Just got to be brave enough and consistent enough to be able to step in and take advantage of some of those opportunities.
So final question, let's bring it all together with 150 years of history plus at Digit, and what you're offering investors. How do you pitch yourself to someone with a balanced portfolio? What do you bring that perhaps maybe other opportunities don't bring to a balanced portfolio for someone investing for the long term?
Yeah, and I think that's exactly the way to think about it, Jeremy, which is that at the end of the day, Digit offers something quite different within the UK equity income space. So there's a lot of value-orientated managers, a lot of value large cap managers. A lot of them have done very well over the last 5 years, and conditions have been pretty favourable for that type of investing. Now, Dunedin's offering something quite different, that focus on quality, that focus on sustainability, a particular focus on mid-caps. All three of those areas have been somewhat out of favour, but we know over the long term, those are good trends to back. But we've had 4 or 5 years where that's not been the right place to be. But Dunedin offers quite a good complement to somebody who's got a lot of, say, a portfolio that's got a lot of banks or various other higher yielding assets within it. Dunedin's offering you something quite different. And again, I think the yield is also pretty attractive. So, extremely well underpinned, as we talked about from reserves and earnings. Again, a significant premium to the market, significant premium to the sector, significant premium to cash. So we think it's that combination of something that's very differentiated from the wider market, as well as offering a very attractive income story and a long-term history of delivery. We think when you put all of that together, Dunedin should be a pretty attractive opportunity for people.
It's been a pleasure, Ben. Thanks indeed for joining us.
Thank you, Jeremy.
Talking to us about the Dunedin Income Growth Investment Trust. That's the co-manager, Ben Ritchie.